The Mises Institute is holding our Revisionist History of War Conference May 15th through 17th here at the Mises Institute. There's still time to sign up at the link below. The paper I will be presenting shows how the Confederate economic policies led to Union victory using the Battle of Vicksburg as a case study regarding the underdog theory of war. There is a link below to sign up for what promises to be a very intellectually stimulating event, especially for those interested in history and the prospects of war. Hello, everybody, and welcome to another episode of the Minor Issues Podcast. I'm Mark Thornton at the Mises Institute. Well, President Trump claims to know a lot more about interest rates than Fed Chairman Jay Powell. Is that really true? What does President Trump know that Jay Powell does not? Or is this all just political theater from Washington, D.C. and the mainstream media? I want to discuss this issue, but not in terms of the typical media talking points of the day. This issue has major implications for the economy, your investments, and possibly even major party political realignment in the important years ahead. As background, economists model tariffs as a one-off. Tariffs restrict our ability to cooperate with foreigners, reduce our ability to consume, induce inefficiencies, and cause a one-time upward shift in some prices. But they do not cause inflation, and they do not cause business cycle crises. Those two problems are the result of the Fed and its monetary policy. No matter how ill-conceived, tariffs do not cause ongoing economic meltdowns, except in the extreme case of an airtight blockade or a complete isolation policy. As bad as Trump has conducted his policy, the problem of the federal deficit, the national debt, and the Fed's reckless monetary policy makes Trump's tariffs pale in comparison. So is President Trump trying to prod Jay Powell into offsetting the impending price hikes from tariffs? Or does he simply want to excite the investors' animal spirits in some sort of neo-Keynesian fashion? Or does he understand Austrian Business Cycle theory, knows an economic crisis is already coming, and is trying to place blame, correctly, on Powell? In my opinion, that last hypothesis seems like a big stretch of the imagination. What we do know is that Jay Powell has already cut rates last year and is poised to cut rates further this year. My expectation is for more cuts than everybody anticipates, and that it will do the economy or the stock market little good. At present, interest rates are not historically high, or even high in inflation-adjusted terms. Why is Jay Powell delaying rate cuts? Is he perhaps more worried about inflation as he claims, or is he just out to make President Trump look bad? Well, it's hard to concretely argue that Powell is trying to make Trump look bad. If Jay Powell holds tight on rates a while longer to supposedly help price inflation and defend the U.S. dollar, he is helping President Trump meet his campaign pledges to reduce inflation and have a strong dollar. If Powell cut rates, he supposedly helps President Trump with his promise to invigorate the economy and to send stock markets ever higher. Powell's flanks are covered, and his defense is bolstered by a compliant anti-Trump media. Both President Trump and Chairman Powell cannot have it both ways, because we do have two problems, and both are not related to tariffs. There is our first problem with the previous monetary inflation from the Fed and a higher price level that reduced our real wages and incomes. Now, we seem to be having a second problem with companies and their capital investments, which were artificially induced by the Fed policies during the previous administration. These twin problems, both caused by the Fed, are now Trump's twin towers. Trump and Powell seem to be arguing over which tower is more important and falling faster. If both towers were to magically disappear, President Trump could be praised as one of the greatest economic presidents since Eisenhower or Reagan. Capital investments are currently suffering from rising costs and reduced demand. This is what you might expect, analyzing the current situation from the perspective of the Austrian school's business cycle theory, ABCT. These problems are certainly not yet readily apparent in an extreme way, and it is easy for the media and pundits to confuse them with the tariff issue. The test of who is right, Powell or Trump, will be revealed, but they could both be wrong. We could get both a worse economy and recession, as well as higher prices and a weaker dollar, or a stagflation situation much worse than tariffs would ever suggest. This worst-case scenario would mean the Fed has manipulated the economy to the point where there are no easy Keynesian fixes to make the aggregate statistics look better. The expected default reaction would be for the Fed to flood the banking and finance sector with more paper money, or inflation, to muddy the statistical waters, and for the Fed to become the buyer of last resort for government debt. Well, let's see how this all plays out. Beyond the unemployment numbers and consumer price statistics, let's keep an eye on the various sectors in the S&P 500 stock index. If the ABCT is in play, we should expect the technology and consumer discretionary sectors to do poorly, and the utilities and consumer staple sectors to do less bad, while the overall index declines. The impact of tariffs is expected to impact both types of consumer spending, but to have less impact on technology and utilities. If ABCT is right in this case, the cause is Jay Powell and the Fed's previous policies going back to COVID. Although President Trump will suffer the political consequences. This will be further confirmed if the economy and stock market doesn't recover when Jay Powell does cut rates beyond any initial bounce, meaning President Trump was also wrong. If the Smoot-Hawley tariff did not cause the Great Depression, President Trump's tariffs will not cause the next economic crisis.